What is cost basis and how does it affect the tax liability of an asset? Cost basis is a term that is often thrown around when talking about transfer of property. So I thought we would take a little time to discuss what cost basis is. Cost basis is the original purchase value of an asset. Sounds pretty simple, right? For most assets that are like real property, for instance, you will be able to depreciate the value of that asset. So if it's personal property, such as office equipment, or if it's real property, such as land or buildings, you will be able to depreciate those. I deal with financial services and financial products, so I'm going to talk about cost basis in relation to assets held in those types of products. So cost basis does not apply to qualified accounts. Since 100% of your qualified account will be taxable upon withdrawal or transfer, the cost basis is not really an issue here. Most of the time it'll say not applicable, or some accounts may say zero. So cost basis will represent the portion that has already been taxed. Again, your original premium of after-tax dollars that funded your product, whether that's stocks, mutual funds, annuities, or even life insurance. Now, cost basis is transferable in some cases. You can do a 1035 exchange, for example, with an annuity product. Cost basis determines what portion of your product is taxable. So if you have long-term gains or short-term gains, your capital gains rate tax will be a little bit different. However, the fact that it's taxed on a last in, first out basis will be the same regardless. So if you are taking distributions, systematic distributions, you might have what they call an exclusion ratio, meaning part of your payment will be a return of basis and part of it will be gains. So it's important to know when you're taking your withdrawals what your options are and which portion of it will be taxed. Now, there is a step-up rule for transfer of securities on death. So if you have some stock that maybe you got from an employer as part of your pension plan, or maybe you held your other assets, maybe Walmart stock or a mutual fund, anything of that nature, in a Edward Jones account or even a digital account online like Schwab or E-Trade, when you transfer those securities to your beneficiaries upon your death, they get what they call a step-up basis. So any gains that you never realized, meaning you didn't sell the asset, stayed in the security, rather than hold the beneficiary responsible for paying taxes on a security that you maybe gave $10 for that's now worth $100. They step up the beneficiary's basis to the current market value. So all of those gains are forever deferred. The current administration is looking to eliminate the step-up basis for securities and even on real property. That right now has not taken effect. The step-up rule is still in effect. If that changes, we will, of course, let you know. But this is a huge thing for the taxation of assets for beneficiaries as well as the original owner. So if you want to transfer before death, you have gift taxes. So as an important part of your planning, your retirement planning and your wealth transfer planning, you need to take into account the step-up rule and capital gains taxes. Now, annuities don't have this same step-up rule. So any gains in an annuity will be deferred, but the cost basis will remain the same, even if the asset is transferred while you're alive via 1035 exchange to a new annuity or life product, or to your beneficiary upon your death. The cost basis is something that the annuity carrier must keep up with and must disclose. So Keeping good records of that and determining that before you take a withdrawal could be very important, as it will affect your tax liability for the calendar year in which the withdrawal was taken.